Hey everybody, today we're going to be talking about term loans and most specifically equipment term loans. These are not going to be, this term loan, this video is not going to be related to real estate loans, mergers and acquisition loans, anything like that. It's going to be specifically geared towards equipment. Why? Because buying equipment is a big part of running and owning a business. So let's jump into it. First, your borrower. Who's your borrower? Your company. The company that is going to be using the asset is going to be the borrower for this particular facility. Next, you have your facility type, which I already talked about at the beginning of the video, which is a term loan. All right, now let's get into the nitty gritty here. Amount. So, what is going to dictate the amount? Your relationship related to your cash flow of the business. What can your business support? That, of course, is going to be one of the qualifiers. But then also, what's going to dictate the amount of the term loan is going to be that particular equipment you're buying, how much it costs, and then how much that bank is willing to advance on that equipment as collateral. In these situations, sometimes banks will only lend 75%, sometimes banks will lend a little bit more. Sometimes banks, if they really know the specific type of equipment or have those particular programs, they'll lend the whole 100% and allow you to finance the whole deal. So that is what usually dictates the total loan amount. Moving down, you have your tenor. And again, tenor is just how long this loan is going to be repaid for as you use the equipment. So usually on equipment loans, you're going to see terms of or tenors of 36 months to 72 months. Now, of course, that's the usual time frame. You can get even longer based on what it is, and if you can make a sound argument that the life, because they're always trying to match the life of the loan with the useful life of the equipment. So if you have a piece of equipment and you can argue that it's good for 15 years and it's not going to need a bunch of refurbishments or anything like that, you can probably get a 15-year tenor on a deal. However, I'm doing the usual. These are, really getting more of the bulk of these type of transactions. So in this situation, I would say the usual is going to be 3 years to 6 years, 3 years to 7 year or 7 years, somewhere in there is going to be your usual life of the loan on these particular things. All right, and then amortization, that again is going to match up exactly with the life of the equipment, the life of the loan. And these are going to not deviate as they do in sometimes in real estate and other things. They're going to do what's called fully amortizing loans, meaning the length of the loan is 7 years. The amount it's going to take you to repay that loan is going to be 7 years. There's no balloons on these structures or anything like that. No one wants to have a balloon on an equipment loan. It's just not usual. Now, are there situations where that may be the case? Potentially, but these are going to be fully amortizing loans. They're going to repay over whatever the useful life of the equipment is. And at the end of the day, you're going to own a piece of equipment free and clear that may have a little bit more time left on it, but usually you're looking to buy new equipment, sell off that old equipment, and do this whole song and dance again. So now we're moving down the guarantors. And as I've said in other videos, this could also be other operating businesses you run that are going to use the equipment, but primarily because we're trying to keep these simple, the guarantors are going to be you. Why? Because in order to repay the loan, you are going to need to run that equipment and generate the money that is needed to repay for the equipment. I am a banker. I don't know how to use the equipment. I don't have the relationships or contacts needed to use the equipment to sell whatever end good or service you're providing or value add service you're providing um, to make money. So I'm going to put you on the hook, and that way you're properly incentivized and aligned to use that equipment to generate additional cash flow to pay me back. Moving next down the list, again, the collateral, what's it going to be? It's going to be that specific piece of equipment. Now, if you have other facilities too, that equipment could somehow get roped in to cross collateralizing those facilities. But yeah, it's going to be that specific equipment. They're going to take a UCC lien on the specific equipment when you go into the UCC or whatever. I don't know about other states. I'm a Florida guy, but it might be different in other states. But they're going to go in. They're going to look at your the lien information on the equipment, and right on the bottom of the page, it is going to say uh, the specific equipment noted, blah, 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 blah. And it's going to spell out exactly what that loan is secured by. So again, the collateral is the specific equipment you are purchasing. The maturity date, again, that's going to match the tenor of the loan. If the loan is for 5 years, the maturity date is 5 years from closing. Pretty simple. Okay, now let's get into more of the nuancy stuff. Covenants. So with these particular types of facilities, you're going to have, and this is pretty much across all banking relationships. This is a very conservative structure. A lot of times you'll just see more a cash flow covenant, which is the debt service coverage, which we all kind of know, but I'll talk about it anyway. But first, I wanted to talk about a balance sheet covenant. And one of the balance sheet covenants that can be used is like a debt to net worth covenant, a debt to tangible net worth covenant. And so, what that is really kind of assessing is that you are not one taking too much money out of the company, and that your business isn't over levered. So, if you do need to sell that equipment or your business needs to go into liquidation, you're going to be able to generate enough cash from the sale of all these equipment pieces and everything else you own to pay back the bank in full. So, for example, you get a loan for 100 grand for a piece of equipment and you have to sell it in a distressed situation. Well, what if you only get 80 cents on the dollar? Then you're missing the additional 20 grand. Well, what the bank is going to do is they're going to look across all of your assets and they're going to go, well, actually, Bob has $1 million in tangible net worth or net worth. So even if he does have to sell off this piece of equipment and he still has a little bit of loan to repay, he is able to sell all of his other pieces of equipment and other things that he has, recoup probably not $1 million in this situation, probably more like 750 or something like that. But he can still pay us our additional 20 grand back, and us as the bank can walk away and we can be repaid in full. So that's kind of the general idea behind that. Now, of course, there's some nuances. That doesn't cover all situations, but that's the general premise. And then moving down again, like I spoke about, we have our cash flow covenant. And again, this is more to make sure that you're not taking too much money out of the business. The sales that you're generating from using that piece of equipment are sufficient enough to repay and service the debt, really, so you have a business that's viable, makes sense, and that you're not just getting this piece of equipment and you don't know what to do with it or how to effectively monetize it. So that's really what that covenant is going on. And a lot of the times, if you do have this, and again, like I said, this is the most conservative structure. Sometimes for small pieces of equipment, they won't give you any covenants because the bank has enough confidence that they can take that equipment back, sell it to somebody else, and be recouped in full. And also, too, these facilities, they're usually not as large. And so it becomes very cumbersome for the bank to monitor all these covenants, even on small facilities. And so they don't want to do it. But again, usually you'll have a debt service coverage covenant because you have some other loan or anything or something like that, and they'll just tie it into your equipment loans as well. So that's how that'll fall into place. And now again, finishing off with pricing. So usually they're going to do a US Treasury note. They're going to match it to the tenor of the loan. So let's say you have an equipment loan, it's for 5 years. They're going to take the 5 year US Treasury cost of funds. That's the bank's cost of funds, and then they're going to put a spread on top of it. And again, depending on the type of equipment, your type of lender, everything else, it could be as small as 200 basis points. It could be as large as 700 basis points. It just depends on the credit profile of your business, how new you are. I mean, the list goes on and on, but you get the general idea. And also, talking fees now, the fees are going to be pretty straightforward. They're usually only going to charge 25 basis points, 50 basis points at the most. It's going to be one time. There's not going to be any nuance or funny business going on here like there are with other facilities where they're coming back and trying to get more later on. This is a one and done type deal. You buy your equipment, you pay a 25 or 50 basis point fee, you pay it off in 7 years, you sell the equipment, you recoup some additional funds, and then you do the whole thing again. So hope you enjoyed this video. We're talking equipment term loans here. That's really all the nuances of this. These are pretty straightforward, usually very easy to get if you are an established player in the game. And even if you aren't, you usually can even just tap a vendor and they'll try and plug you in because, again, they can take that equipment back, sell it relatively easy, and are okay taking a risk on you because at the end of the day, they want, they're in the business of selling that equipment or doing these deals, and they want to make money as well. So yeah, again, hope you enjoyed the video. I have more coming here, getting more into the nuances of all these particular structures of each deal. Hope you enjoy it, and see you soon.